Great.
Hi there, everyone. This is Ken Weber, president of Weber Asset Management. Today is January 19th, 2023. I'm here in New York with my partner and friend, Jack Bowers, our chief investment strategist. And this is our first video chat of the year. So we want to jump right into it. We are going to touch on a few things that we always talk about and one or two that we almost never talk about. So Jack, let's get right to something that you and I spoke about earlier that we almost never talk about, and that's money market funds. And we haven't talked about it because for the last several years, money market funds were basically the same as putting cash under your mattress. They paid nothing. They paid literally 0.0001%. Now, as of today, some of the Fidelity, for example, money market funds like Fidelity Cash Reserves are in the range of 3.9% annual. So for those of you who want to, you have a short-term need to put money aside and want to earn something that's more than zero, there are some good options out there. So Jack, do you want to give us your point of view on some of those short-term instruments that are available now?
Sure. Government cash reserves, the yield is right around the 4% mark right now, which means there's a decent shot at keeping up with inflation, at least on a pre-tax level. And so when you're in a core account, you don't always earn the full yield that a money market fund earns. So you may have to actually go in and place a trade to buy the money market fund that you choose so that you can earn these kind of rates. But I think for anyone that has a short investment horizon, even less than a year, this is an ideal way to at least keep up with inflation and stop the erosion in the cash if you have money that isn't committed to stocks and bonds.
Right. So, for example, I mentioned Fidelity Cash Reserves, which is what Weber Asset frequently uses. But there's another alternative, Jack, that you mentioned, another Fidelity fund paying a bit more. What was that one?
That one is Conservative Income Bond. It's
Fidelity Conservative Income Bond is the full name if you're looking it up, right?
Right, FCONX. There's also a municipal equivalent, but these funds are actually bond funds, not money market funds, so they do have some risk to principal. However, they are managed with an extremely short maturity, less than a year. And so as a result, they tend to stay pretty close to their $10 share price.
Right.
I think the yield is roughly about the same as a money market fund.
A little bit higher.
But yeah, a little bit higher. But you also have the potential that if the Fed does get into a situation where they have to cut, these funds may be able to take advantage of that as the short-term rates decline and the yield curve becomes less inverted in theory.
So you not only make a little higher yield, there's a chance you'll actually make some on capital appreciation on the bond.
Right.
The bonds and the bond funds.
These conservative income bond funds are stable enough that you can use them for short-term capital as well.
Right. So again, it's not something that we do for our client accounts necessarily. We might do it on a short-term basis. We're just offering you the information as an alternative for those of you who have that specific short-term kind of need. Now, you mentioned inflation and the Fed raising rates. So let's get right into it. The inflation rate has been the bugaboo. It's been the big problem for the last year or so. I think we peaked at 8.9%, something like that as the annualized inflation rate. It's come down to the 6.5% range.
6.5% at year end on a year-over-year basis.
Right. So just talk to us about how you're seeing where we stand with inflation going forward.
Well, there's still some elevated pressures, which is why the Fed is still raising short-term interest rates. That's mainly playing out in the wage base with wage inflation and to some extent with energy. And those may remain kind of sticky until we get more people into the labor force. I think wage inflation is going to remain elevated, and also
wage inflation means people are getting paid more. It's a good thing for those who are working.
Right. And to the extent that you can have productivity rates that offset that, which tends to happen if productivity is up around 2%. Wage inflation doesn't really hurt. The problem we have right now is that productivity it's been negative as we get back to normal in the workforce. And unless productivity starts to swing up, then wage inflation can remain a problem. And I think that's why the Fed is remaining so vigilant at this point in time. The other factor is with energy, with China reopening so suddenly, that probably is going to keep pressure on energy prices for at least another 6 months, perhaps, until things kind of normalize there. And I think we will see a decline in energy prices, which will help out on the inflation front, but it may be delayed until later in the year at this point.
Now, earlier,
Go
earlier today, Jack, you told me you have a target for inflation by year end. So if you're
Yes.
still willing to make that a public statement, go ahead.
Yeah. No, I think inflation will be below 4% by the end of 2023.
And you wrote that in stone somewhere, right?
No, I didn't write it down, but I can. Yeah.
All right. Well, nothing is guaranteed in our business, but I happen to think Jack's target of 4% or below by December 31st is reasonable. So time will tell, but there's reasons why we say that, and we won't go into all the details. But I happen to agree with you that 4.5%, 4% is sort of my personal target for inflation by year end as well.
The Fed would like to get down to 2, and that is within the realm of possibility, but we'd probably have to have a reasonably ugly recession for that to happen in such a short time.
Well, so let's talk about, since we're talking about inflation and all that, bonds, the whole bond market last year. Look, we're willing to admit it was a sloppy, horrible, terrible year for everybody who was holding bonds and bond funds. It was actually the worst, or one of the worst in 50-year calendar years for bonds and bond mutual funds. There was really no place to hide. We typically use bonds and bond funds for our clients to provide ballast, to provide stability. It really didn't last year. We weren't able to see it coming. It took almost every professional by surprise to some degree or another. Jack, you surprised me with what you told me earlier about your forecast for the bond market.
I think that the bond bear market is over with at this point in time. The Fed may continue to tighten, but because the long-term rates are determined by the global economy, and that's clearly slowing at this point, I don't see bond funds getting hurt by future Fed actions at this point in time. So I think given what's happening on the global front, we even had an event yesterday with the Bank of Japan, holding steady rather than increasing as they were expected. We're now at a position where global factors, I think, will hold down those intermediate and long-term bond rates, so that regardless of what plays out going forward, I think we're in a situation where bonds are more or less back to normal at this point in time. And of course, the yields are higher now.
Let me just touch on that, the Japan non-movement. People thought that their central bank was going to raise rates, and the central bank didn't raise rates. And that is a sign that at least some experts in the global market are becoming a bit more optimistic about inflation. And if that sort of trickles up or down, or however you want to call it, from Japan over to our shores, it's a good sign, reading the tea leaves about future inflation.
Yes, it did cause our own yields to fall yesterday. The Bank of Japan is only at about 0.5% at this point. So that's what was so surprising about them stopping where they are.
Right.
There was an expectation they had quite a bit to go, and they've decided maybe they don't have to do that, or at least they can wait a lot longer. So,
and full disclosure, they're in a very different situation than America.
Yes,
but
they have not seen the kind of inflation problems that Europe and the US has seen.
Right. So it's not apples to apples, but it's a sign of something that's out there in the ether about raising rates. It may not continue to happen. I want to now jump to everybody's favorite area of discussion, the stock market. Most of our client money is one way or another in stock mutual funds over at Fidelity. Jack, it was not a good year for stock investors last year. I personally am a lot more optimistic for 2023. Nothing is guaranteed, but what do you see for this year?
Well, we're in a position where the early earnings are coming in weaker than expected, and a lot of the analysts are now cutting earnings forecasts, and so that's taking away a little bit of the early year rally that we saw. And it's hard to know how far that will go. There is a very wide range of possibilities on the economy. We could have a soft landing. We could have a mild recession. We could have a severe recession. And it's not really clear at this point which one of those is going to be what happens this year.
Opinion is all over the place. There's no consensus, really.
Not much consensus. So, so the stock market sell-off may already be over, or it may have a while to run before things truly bottom out. But I'm optimistic, at least from an opportunity standpoint, because large cap growth stocks are a lot less expensive. The forward PEs are not much higher than the S&P 500 at this point. And these companies are likely going to be able to hang on to at least some growth going forward. So that might be an opportunity. The other big opportunity is with mid caps and small caps, which as measured by the S&P 400 and the S&P 600 are showing substantial discounts to the S&P 500.
Right, some bargains out there.
And so I think there's an opportunity just being in mid caps and small caps. You know, even if the market doesn't turn up, we at least, you know, could potentially outperform with smaller stocks. And so most of our portfolios are already positioned to take advantage of that. And the few that aren't, we're now kind of rapidly moving them into place so that we at least have a better chance of outperforming this year. So last year it was really tough to outperform relative to the S&P 500. And I think that's because with the labor shortage and the rising interest rates, it kind of played all to the strength of the large cap companies, which have more labor efficiency and ability to get the stuff they need in a disruptive time. But with all that reversing this year, I think the smaller companies could benefit. And so that is a relatively easy thing to take advantage of with mutual funds. And I look forward to posting better results relative to the S&P 500 regardless.
Let me point out that the big unknown in the short term certainly is the debt ceiling argument. It's going to be a political mess in Washington. And that will roil the stock market. So don't panic. The stock market could really sink if it looks like the Democrats and Republicans are at each other's throats. That's going to be temporary. But then Jack and I both agree that by mid-year, by June, July, as they settle those things in Washington, I think we both agree that there's a good chance the stock market will rally possibly quite strongly by summer.
Yeah, our trade balance is looking pretty good these days. So, you know, even if the government were to go bust, I don't think it's going to measurably increase the recession risk at this point in time. So the last few times that there have been close calls with the debt ceiling, the market has more or less ignored it. So that is a possibility of how things will play out this time.
And we'll just point out for those of you who are not economists that the stock market is not the economy. So actually, if the unemployment rate, for example, starts ticking up, well, that actually will be good for the stock market because it means the Federal Reserve will stop raising interest rates. So the economy could start having some trouble, but your stock market portfolio will probably, can't guarantee anything, but will probably, based on history, do well.
Yeah, as long as the downward earnings revisions aren't too severe.
Right.
There could be a situation where bad news on the economy does benefit the stock market.
Bad news is sometimes good news. You never know. That's the game we're in. But if you take the long-term view, you'll do well. Jack, we've bumped up to the end of our allotted time. So thank you for all your wisdom, and we wish you all Happy New Year if it's not too late, and we'll see you next time. Thank you.
Right. Bye-bye.
Bye-bye.